Hey, what's going on? In this video, we're going to discuss how interest rates work for an investment property. In this show, we talk about entrepreneurship and investing for value. That's it, value add. So let's get right to it. There are two types of loans that are for investment properties, or just for properties in general. Number one, we have the FHA loan. We're not going to discuss this loan in this video, but I think it's good to explain the difference between this loan and an investment loan. So typically the interest rate for a FHA loan is less than an interest rate for an investment property. And the reason why is because there's less risk. Because the person is taking out a FHA loan will most likely occupy the home. And so if someone is an investor, they're not going to occupy the home, so it's a higher chance that that person or that investor will default on the home. But however, if the person owns the home and they occupy the home, they will think twice before they default on the loan. Right now, the interest rates that I've just looked up for today is 3.64%. Interest rates for an investment loan are about 5.25%. Some, depending on your credit score, can be in the 6% range. So that's pretty much how that works between those two loans. So let's say you are taking out not a FHA loan, but you want to invest in a piece of real estate. So initially you would probably look for a house that needs some work. Once you identify the house at a 65% LTV, then you can figure out what lender to go through. Now, depending on your credit score and how high or low it is, it depends on the interest-only rate they'll give you. Now, typically that rate is between like 9% and 14%. Now, what this means is that, let's say the entire loan amount is $200,000. The interest rate is 10%. So that means you would pay 10% on $200,000 over that year, interest only, in monthly payments. So every time you pay the lender an amount, every time you pay the lender every month, that amount will not go towards the principal. And the reason why, because it's a short-term loan. So after that happens, you renovate the house, you hold the property for at least 4 to 6 months. Most lenders require that you hold the property for this amount of time. I don't know why. All I know is that you got to hold the property for at least 4 months before you can refinance out of that interest-only loan. And then you refinance it into an investment stabilized loan at about 5.25%, in the 5% range or the 6% range. Again, depending on your credit score. So keep your credit score high. So this is pretty much how interest rates work